Hello everyone. Today here we have got another question from 2016 paper 2 past exam. In this question you'll first learn to differentiate between the capital and the revenue expenditure, and then we will prepare the accumulated depreciation and the sale of non-current asset account. As always, you'll find the question on the left hand side of the screen, and on the right hand side you'll see all the workings which I'll go through step by step. So with that being said, let's begin. All right. The accounting year of Jin Yin's business ends on 31 October. During the year ended 31 October 2016, the business bought a second-hand delivery van. The first requirement of the question is to show which items are capital expenditure and which are revenue expenditure. Now, before we answer the question, let's try to understand the difference between the capital and the revenue expenditure. Now, what does the capital expenditure stand for? Now, the capital expenditure is basically when you are purchasing a new non-current asset or adding value to an existing non-current asset. When I say adding value to an existing non-current asset, it can refer to any modifications that you may do to any new non-current assets that you have already purchased before, or you can install some camera equipment in a building, which is essentially you adding more value on top of an existing non-current asset. The new value being the security cameras and the existing non-current asset being the buildings. All right. So just to simplify, capital expenditure is when you purchase a non-current asset or you add value to an existing non-current asset. All right. And what about revenue expenditure? Revenue expenditure refers to the daily operational expenditure for the business, which can refer to all the expenses that a business has that it incurs to make profit. All right. So let's look through the options that we are given and answer which are capital and which are revenue expenditures. Starting with the first one, purchase price of delivery van. So when you're buying a delivery van, you're basically buying a non-current asset, right? And the price here that's being referred to is the purchase price, which is the cost of buying the non-current asset. Based on the definition we have looked earlier for capital expenditure, it is a capital expenditure when we buy a new non-current asset, right? So therefore, the purchase price of a delivery van is what we would classify as a capital expenditure. Next, special shelves fitted into the delivery van. Now, the delivery van in itself was an existing non-current asset, and then we added more value to this existing non-current asset. And this extra value is being added in the form of special shelves, which we have fitted, right? So when you fit the special shelves into your delivery van, you're adding more value to your existing non-current asset. And therefore, this is also following the definition of capital expenditure. All right, so in this case, you're also going to select capital expenditure as the current option, as the correct option for number 2. Number 3, annual insurance premium. Now, annual insurance premium refers to an expense, which is the insurance expense in order to protect the asset from any damage that you may possibly incur. Now, this is referring to the day-to-day operational expenditure of the business, right? Therefore, this falls into the category of a revenue expenditure. We are not buying any non-current asset in this case, nor are we adding value to an existing non-current asset. We are simply paying for some kind of maintenance, which in this case is the insurance that helps you protect your losses if the asset gets damaged. Okay, so therefore, this is what we classify as a revenue expenditure. Point number 4, replacement of tire damaged during the year. So when you're replacing a tire, you're not really adding any value. Okay, so the tire that comes with the delivery van that gets worn off and it goes through obsolescence as we use within our business, right? So if you're replacing this tire, you're basically maintaining it, which is an expense, and therefore this is under the category of a revenue expenditure, and we should classify this as a revenue expenditure. Okay, all right. So part A, just to simplify, capital expenditure again is when you buy a new non-current asset or you add value to an existing non-current asset, and revenue expenditure refers to the day-to-day operational expenditure of the business, which also refers to all the expenses that a business incurs. during a year to make profit. All right. So now we're going to move to the second part of the question. The second part of the question, on 31 October 2016, equipment which was bought on 10 March 2014 for $12,800 was sold and the business received a check for $4,500. Equipment is depreciated at 25% per annum using the reducing balance method. A full year's depreciation is charged in the year of purchase and the year of sale. And the requirement is to prepare the accumulated depreciation of equipment account for the year ended 31 October 2016 to record the sale of the equipment. All right, so let's look into the workings on the right-hand side. So we understand that we have sold an equipment which we had purchased on 10th of March 2014. All right, so I'll just highlight that here. Equipment bought on 10 March 2014. So this was the day the equipment was sold. All right, so sale date. This was the day the equipment was purchased. All right, okay, so purchase date. And the equipment was sold on 31 October 2016. Now, the first year of usage for this equipment would be from 10 March 2014 until 31 October 2014. And this is based on the fact that we bought the equipment on 10 March 2014 and the first financial year would have ended on 31 October 2014. Based on the company's policy, we are to apply a full depreciation in the year of purchase, which is the year ending 31 October 2014, right? Whenever we are using the reducing balance method and you want to find the depreciation, especially in the first year of purchase, you just calculate it by multiplying the given percentage with the original cost. All right. The given percentage on the question is 25%, which you'll see here, 25%. And then we're multiplying it with the original cost of 12,800. All right. The question explicitly mentions the equipment which was bought on 10 March 2014 for $12,800. So this is referring to the original purchase price or the original cost of this equipment. All right. So the full depreciation in this case is calculated by multiplying the given percentage of 25 with the original cost of 12,800, which gives us a full depreciation of $3,200 in the first year, which ends 31 October 2014. Now, because you're using the reducing balance method, always remember to calculate the net book value at the end of the financial year. And the net book value at any given point in time can be calculated simply by finding the difference between the original cost and the accumulated depreciation. The original cost, as we know, is 12,800, and the accumulated depreciation in the first year is basically the depreciation which we have calculated earlier, and that is $3,200, which gives us a net book value of $9,600 at end of 31 October 2014, which is at the end of year one. Okay? All right, so just hold that thought for a moment and see if you can understand what we have just discussed. All right, so when you're ready, we'll now move to the second year of usage for this asset. Now, we understand that we are working with a business where the financial year ends on 31 October, as mentioned in the very first line of this question, which you can see I'm underlined in red. All right, so this means a financial year typically begins on 1 November and ends on 31 October of the following year, right? Okay, so in that case, year two for this asset will start from 1 November 2014 and end on 31 October 2015. Isn't that so? So when you're using the reducing balance method and you want to find the depreciation, you multiply the given percentage on the net book value, which is which is the main difference between the reducing balance and the straight line method. And in this case, we're applying the reducing balance method, and that is why we're doing the net book value. So you're multiplying 25% with the net book value of $9,600, which we had at the end of year 1 or at 31 October 2014. And on that basis, the depreciation comes out to be $2,400. Okay, so once you have the depreciation, you want to find the net book value at end of year 2 or at end of 31 October 2015. So I've written NBV, which stands for the net book value in short, and that is simply the difference between the net book value from the previous year that we had minus the depreciation that we have calculated right now in year 2. Okay, and that gives us a net book value of $7,200, which is the net book value that we have at end of 31 October 2015. Okay, all right. Now, so in year 3, which is going to start on 1 November 2015 and end on 31 October 2016, basically the day the asset was sold, you are to also find a full depreciation based on the company policy, and we would be calculating a full depreciation anyway because it had been used in year 3 for the entire 12 months. So the full depreciation again in this case is applied by using the percentage of 25 and multiplying it with the net book value that we had at the end of previous year or at end of year 2, which is $7,200. So when you multiply 25% with 7,200, you get $1,800 as the depreciation that you have incurred in year 3. So the net book value at end of year 3 is the difference between the net book value that we had at end of year 2, which is 7,200, minus the depreciation that we derived for year 3, which is 1,800, and that's how we get 5,400. All right? Okay. So when you're ready, now we can officially start preparing the accumulated depreciation of equipment account. So here I have already prepared an outline for you in advance, and I've used the regular format that we're used to, which is the 5-column format that we have. So we have got the date, we have got all the description, all the cross-reference, then we have got 1 column for debit, 1 column for credit, and 1 column for the final balance. So we are preparing the accumulated depreciation of equipment account for the year ended 31 October 2016, which you can see I'm highlighting in green on the left-hand side. All right. And this would be a 3-mark question during your exam because we will mainly have 3 entries in between 1 November 2015 and 31 October 2016. So 3 entries which carries all these 3 marks. So let's see what's going on. All right. So our year starts on 1 November 2015. All right. And we will obviously have an opening balance. And the opening balance, as you can see, is here being referred to as balance brought down. And accumulated depreciation of equipment is by default a contra asset account, which always should have a credit opening balance. So what do we understand by a contra asset account? A contra asset account records the reduction in a relevant non-current asset, which in this case is the equipment. All right. So the equipment at cost account in itself is a debit account because it's an asset account. And the accumulated depreciation account being a contra asset account, which records the reduction, it has to have therefore a credit opening balance by default. So which is what we are including here. So 5,600 credit. All right. Okay, so 5,600 credit is the opening balance that we have shown here. Now you may wonder, where did we get this 5,600 from? All right, so this 5,600 is the opening balance that we have on 1 November 2015. Okay, so let's scroll back up. Okay, so 1 November 2015 starts in year 3. All right, and years 1 and 2, we had depreciation calculations involved. So we want to find the accumulated depreciation that we have calculated in total for years 1 and 2. And how do we do that? In year 1, we have calculated a depreciation of $3,200. Okay, $3,200 plus in year 2, we have calculated a depreciation of $2,400, which altogether gives us an accumulated depreciation of $5,600 for year 1 and 2 combined, right? And this is the depreciation in total that we have at 31 October 2015 for years 1 and 2 combined, which gets forwarded as the opening balance on 1 November 2015 when we start a new financial year. And that's the amount that we have shown in the 5th column here, 5,600 credit. Okay? All right, so that's how you get 1 mark. Then, on 31 October 2016, you can see we have moved to a new financial year. Therefore, we have changed to 2016, 31 October. We have sold a non-current asset, all right? So the asset that we have sold, okay, we want to know the total accumulated depreciation right before we sold this asset, okay? All right. Now, the total accumulated depreciation is calculated. I'm just going to write accumulative, okay? So we had 5,600 for years 1 and 2 combined, which you will recall what we have done earlier, plus an additional 1,800. Isn't that so? Additional 1,800 that we have calculated for year 3. So altogether, we are getting 7,400 for years 1, 2, and 3 combined, okay? So that's 7,400 in total for 3 years of accumulated depreciation. Now, this is what we have included within the debit column here. And the cross-reference for the account we have used in this case is the sale of non-current asset. Why do you think it's within the debit column, 7,400? Because think about it. When you have sold a non-current asset, you need to remove the accumulated depreciation from the books. You need to reflect that within the books or within the accounts, right? So accumulated depreciation of equipment needs to go down because now you have got rid of the accumulated depreciation for an equipment which we have already sold. So if you need to show that reduction or decrease, you have to debit it, because when accumulated depreciation increases, we credit it, as you have seen with the opening balance before. Now that we are removing this effect for an equipment, we have to reflect this reduction by showing it within the debit column, which states that the accumulated depreciation is now decreasing because we have removed an asset from our books. So that is why 7,400 is being shown on the debit column, okay? So on that basis, the final balance comes out to be 1,800 debit. How is it 1,800 debit? First of all, the difference between 7,400 and 5,600 is 1,800, okay? And it is debit because you see all the credit balance we had, which was 5,600, would now have been offset entirely by this massive amount of 7,400, and which means more weight now lies on the debit side, right? So therefore, 1,800 debit is the balance that we have left once we have got rid of this asset. Next, during this financial year, we have also calculated an additional depreciation of 1,800, and when we calculate an extra depreciation, it increases the accumulated depreciation as well. Therefore, this 1,800 is shown on the credit column, okay? And that's how we arrive at a net balance of 0 at 31 October 2016, because we don't have any other assets or equipment in the books at this moment. Okay? All right. So for you to get better with questions like this, practice is highly recommended on a daily basis, where it becomes very easy or child's play for you, and you can easily score full marks. You can also check other videos that I have done on depreciation and how to navigate through complex questions, and you'll find plenty of them which I have covered. So make sure to check those out. All right, so let's move to the next thing that we've got now. So question C. Prepare the sale of the non-current asset account for the year ended 31 October 2016. And this is going to be a 5-mark question in your exam. All right, so before we can prepare the sale of the non-current asset account, I need you to always manually calculate whether or not you've got a profit or loss on disposal, a profit or loss on the sale of this asset. Now, how do we determine that? Now, the net book value at any given point in time refers to the economic benefit within the non-current asset that is still available for consumption or usage within the business for the purpose of generating revenue, right? Now, the net book value during disposal was 5,400. And how do we know that? This is the net book value that we had at end of year 3. Isn't that so? Let me recall again. So the original cost was 12,800, which was the amount that we paid to buy this asset on 10 March 2014, right? Right? Okay. In the first year, we had got depreciation of how much? It should be, I think, let me just scroll back up, 3,200. So in the first year, we have got a depreciation of 3,200. So 12,800 minus 3,200. In the second year, we got a depreciation of 2,400. And in the third year, we got a depreciation of 1,800. So when you subtract all these 3 depreciation from the original cost, you're left with 5,400, right, as the net book value. Now, the disposal proceeds, which refers to the amount that we received by selling this asset, was 4,500, which the question clearly mentions. If you check the second paragraph underneath question A, was sold and the business received a check for $4,500, right? Okay, so the disposal proceeds is 4,500 and the net book value or the economic benefit available was 5,400. This clearly indicates that we had sold this asset for less than what it had remaining in terms of value, right? And therefore we had sold this asset for a loss, and the loss on sale or the loss on disposal is therefore the difference between the net book value and the disposal proceeds, which is $900. And this is essentially which we want to prove by preparing the sale of non-current asset account, and that's how you will know if your math is 100% correct for 5 out of 5 marks in the exam. Okay, so let's look into the sale of non-current asset account. So we have prepared an outline as before in the typical format that we're used to, which is the 5-column format, starting with the date, the account for cross-reference in the second column, the third column being the debit, the fourth column being the credit, and the fifth column being the final balances that are available at a given point in time. Now, everything happened on the 31st of October 2016 with regards to the sale of the non-current asset. So we are starting our time with 31 October 2016. Whenever you're preparing the sale of non-current asset account, the first thing that you should remove or the first thing that you should show is the cost of the asset that we had sold, okay? And I'm gonna show you some journal entries so that you understand how everything adds up. All right, so make sure to focus and follow through so that you have a clear understanding. First of all, as we have mentioned, we want to remove the cost of the asset that we had sold, okay? All right. Now, my question to you is, if we are removing an asset from our books, it's basically assets going down, right? And when assets go down, do we debit or credit them? We credit them. When assets increase, we debit them. And when assets decrease or when assets go down, we credit them. Make sense? Okay. So the asset that we're talking about in this case is the equipment, right? So we would end up crediting the equipment at cost account, the original cost, which is shown within the equipment account, and we would be crediting that. Make sense? And we would be crediting that by 12,800. okay? Because now assets are going down because we don't have this equipment, which was originally worth 12,800 in our books, right? And what is the contrasting entry against this credit? We are removing this asset because we had sold this asset, and we would be debiting the sale of non-current assets. So I'm just writing NCA in short, okay? Do you get what I mean now? So we would be debiting the sale of non-current asset by 12,800, and we would credit the equipment by 12,800. So when we credit the equipment by 12,800, we are essentially saying that this asset is no longer in the books, and therefore, because this asset is decreasing, when assets go down, we credit them. And that's what we have done here, okay? Now, again, remember this. We have just debited the sale of the non-current asset account when we are removing the cost of the asset that we had sold, right? Now, let's go back to our main account. So here what we have done for 31st October, the cross-reference for the account is equipment, and we're debiting the sale of non-current asset account by the cost of this asset, which was 12,800. So do you see how it's relevant to the journal entry that we have just done, okay? And the final balance that is remaining is 12,800 debit at 31st October for the first row, okay? Second, we want to remove, okay? We want to remove the accumulated depreciation. So I'm just going to write accum debt. So remove the accumulated depreciation of the asset that we had sold. All right. So now we want to know the journal entry for this specific transaction. Now, accumulated depreciation, as we know, by default is a contra asset account. And when we say it's a contra asset account, we know that it records the reduction for a relevant non-current asset, which was the equipment account, right? So when the accumulated depreciation increases, we credit it. And now that we have to remove this amount because of one asset that we had sold, which no longer exists in the books, we have to reduce it, right? So if accumulated depreciation by default is a credit account, when it increases, it's a credit account. Now that we're removing the asset, now it will become a debit account, right? Because now we have to reflect that reduction by debiting it. So we will debit the accumulated depreciation account. Isn't that so? And the total depreciation for this asset that we have so far, as you may remember, was 7,400, which was 3,200 in year 1, 2,400 in year 2, and 1,800 in year 3. Okay? And why are we removing this depreciation? Because we have just sold it, and therefore we would end up crediting the sale of the non-current asset account. Isn't that so? Which means within the sale of non-current asset account itself, on the credit column, we will show 7,400. And our description for the cross-reference of the account would be the accumulated depreciation. So let's check what's happening. So on 31st October, we are removing the accumulated depreciation, which we are recording in the sale of non-current asset, right? And we are showing it within the credit column based on the journal entry which we have done earlier, as you understand how it all relates, okay? So previously, the balance was 12,800 debit. Now we have got 7,400 credit for the accumulated depreciation, which when being offset with each other, leaves us with 5,400 with more weight on the debit side. Make sense? Okay. Now we will see the effects for the disposal proceeds. Okay, we know we sold the asset for a check of 4,500. So when we say we sold this asset for a check of 4,500, so check here refers to the cash that we have available in our bank account. So that means our cash at bank should go up, right? Because we're getting a check and we deposit this check into the bank account eventually. So when Cash at bank, which in itself is an asset account, goes up because of the amount we're receiving by selling this asset. We are going to debit it because when assets go up, we end up debiting them, right? So therefore, we debit cash at bank, 4,500. And again, why we are debiting cash at bank 4,500? Because of the sale of the non-current asset, which will take the credit entry in this case. So credit is sale of non-current asset by 4,500. Okay? All right. So now we're going to reflect this in the account for the sale of non-current asset. And on the credit side, we will show 4,500 with our cross-reference for the account being cash at bank. So let's scroll back up. You will see on 31 October, cash at bank, and that's recorded on the credit column, 4,500, which you understand why, based on the journal entry we have done. And 4,500 on the credit side, when subtracted from a net balance of 5,400 debit, leaves us with 900 debit, okay? And if you recall, we have made a loss, remember? And that loss was $900, isn't it? And that is what's being used to offset the debit balance that we had got before, which ends up giving us a balance of 0 or nil. And if you want to understand how this works, let me show you in terms of the loss. Okay. So transfer the loss. Okay. Loss on sale of a non-current asset or loss on disposal of a non-current asset is an expense in itself, and all expenses are debited by default, okay? So we would end up debiting the loss on disposal or the loss on the sale of non-current asset account, okay? And because this is an expense and we understand all expenses are debited, we would be debiting 900 anyway. And the credit would be the sale of non-current asset. So that is what we have reflected eventually within the credit column of the sale of the non-current asset account, where you will see 900 is recorded, which translates to the loss that we have made during the year. And the reason we are writing the cross-reference as profit and loss is because we have to show this amount in the income statement or the profit and loss statement, right? And this $900 eventually cancels the 900 debit we had before. So 900 debit, 900 credit. When they cancel out each other, we're left with 0 at 31 October. And that should be always the case, where you end up with a 0 balance when preparing the sale of non-current asset account. All right? Okay. All right. So that's all for today's lesson. So I believe you found value in this content. Make sure to post in the comments whatever other topics you need me to cover, and I'll see you in the next video.